Shares, a financial tool. Welcome back to DJ Tutorials. Today we are looking at shares, another way of increasing your financial stability. So let's dive in. Shares, also known as stocks, can increase your finances through capital gains, selling shares for a higher price than you bought them, and dividends, payments from a company's profits if they choose to distribute them. Investing in the stock market, either directly or through funds, allows you to participate in a company's growth and potentially generate income or increase your wealth over time. Here's a more detailed explanation. 1. Capital gains. When you buy shares of a company, you become a part owner, shareholder. If the company performs well and its value increases, the price of its shares will likely increase as well. You can then sell your shares at a higher price than you bought them, realizing a capital gain. This gain is the difference between the selling price and the purchase price minus any fees. For example, if you buy a share for $10 and sell it for $15, you've made a $5 capital gain. 2. Dividends. Some companies choose to distribute a portion of their profits to shareholders in the form of dividends. Dividends are typically paid out on a regular schedule, for example, quarterly. The amount of dividend you receive depends on the number of shares you own and the dividend amount declared by the company. For example, if a company pays a dividend of $1 per share and you own 100 shares, you'll receive $100 in dividends. Dividends can provide a consistent stream of income, especially from dividend-paying stocks. 3. Investing in funds. Instead of buying individual stocks, you can invest in mutual funds or exchange-traded funds, ETFs. These funds pool money from many investors and invest in a diversified portfolio of stocks or other assets. This allows you to gain exposure to a broader range of companies and potentially reduce risk. For example, an S&P 500 index fund would track the performance of the 500 largest publicly traded companies in the U.S. 4. Important considerations. Risk. The stock market can be volatile and stock prices can fluctuate, meaning you could lose money on your investments. Time. Horizon. Long-term investments, holding stocks for many years, tend to offer better returns than short-term investments. Diversification. Spreading your investments across different companies and asset classes can help reduce risk. Tax implications. Investment income, capital gains and dividends is typically subject to taxation. In summary, shares offer the potential to increase your finances through capital gains and dividends, but it's important to understand the risks involved and to invest wisely. Investing in stocks can offer high potential returns and portfolio diversification, but also carries the risk of volatility and potential financial loss. While stocks can be more liquid and easier to buy and sell than some other investments like real estate, they also come with the possibility of capital gains taxes and, if not managed carefully, emotional selling and buying, according to Investopedia and The Motley Fool. Pros of investing in stocks. Potential for high returns. Stocks have historically provided higher returns than many other asset classes over the long term. Portfolio diversification. Investing in a variety of stocks can help reduce risk compared to investing in a single stock. Liquidity. Stocks are generally easy to buy and sell, making them a relatively liquid investment. Ownership in companies. Investing in stocks allows you to own a piece of a company and potentially benefit from its growth. Dividends. Some companies pay dividends to shareholders, providing a regular income stream. Cons of investing in stocks. Market volatility. Stock prices can fluctuate significantly, and investors may experience losses, especially in the short term. Risk of loss. There is always a risk of losing money when investing in stocks, especially if you panic sell during market downturns. Time commitment. Investing in individual stocks can require significant time and research to understand the companies and their prospects. Emotional decision-making. Market fluctuations can lead to emotional buying and selling, which can be detrimental to long-term returns. Capital gains taxes. Selling stocks can result in capital gains taxes, which can reduce overall returns. For long-term investors, the best time to buy is often when stocks are undervalued and the market is in a downturn, while the best time to sell may be when the stock reaches its intrinsic value or when its fundamentals deteriorate. Investors should monitor the performance of their investments by periodically calculating gains and losses. Investors should aim to sell a stock after it experiences considerable growth and before it decreases in value. Overall, you should seek professional advice when thinking of investing. If you find this video useful, please share. See you next time.